Welcome, everyone. We're so happy to have all of you viewers here today for our inaugural FOMO-Free Financial Future Conference. You're in for a real treat. The lineup of all-stars that we have today is absolutely incredible. You're going to learn so much. And I have a feeling that by the end of the day, you're going to be thinking about your retirement a lot differently than you have in the past. It's going to be a really great day. Now, before I dig into my presentation, I really wanted to take a minute to comment about the recent market volatility that we've seen. Over the past 2.5 weeks, we've seen bigger daily swings and more volatility in the market than at any other point during this bull market. Now, for sure, that can feel very painful when you go through periods like this, especially when you haven't done it in a long time. But you have to understand that periods like this are absolutely normal. It is normal to see double-digit declines in the market in any given year. In fact, 37% of the time since 1950, the market has experienced a decline of 10 to 20% during a year. That's a lot of time. 1/3 of the time we see that type of decline in a year. Now I get it. This time it definitely probably feels a little bit different because of the impact from coronavirus. That uncertainty, coupled with the uncertainty in the oil market, will likely lead to continued volatility. We need more clarity on those two subjects before we can potentially see a bottom in the market. But investing in volatile times is never easy. History shows us that times like these do eventually subside, and returns are still achieved over longer periods of time. So these are just some things to think about as we continue throughout the day and as you begin and continue to invest over the days and weeks to come. So with that, let's get right into my presentation about retirement. We'll start with the title here, No Excuses. Start saving for your financial future now. We'll move right on into the summary here. Retirement, you've got this. And we're going to talk about what does retirement look like in America right now? What are some common excuses or blockers that we've heard in the past? How do you get started? What's the difference between a 401k and an IRA? What about rollovers? That's a big topic that a lot of people don't talk about. And then eventually we'll get into how Ally can help you. So with further ado, we're going to talk about what retirement looks like in America right now. And you're going to have to bear with me. There's a lot of anxiety out there when it comes to retirement. A lot of people think of retiring is not an achievable feat anymore. And that's because of the stats that you're going to see on this slide. We're going to face some cold hard truths here, but I promise you, once we get past this slide, the rest of the presentation is going to get a lot better. But the facts are here. Around 50% of households have nothing saved for retirement. No 401k, no IRA. So what does that mean? We look at the bubble here on the bottom left, $7,800. That's the median that an average household has saved for retirement at this point in time. Now that includes the people that have nothing saved, so that number is very low. But it does get worse. You look at the next bubble to the right, 4.3 trillion retirement savings deficit. This is a number that I pulled from the Employee Benefit Research Institute. 4.3 trillion. That's the deficit that we have for retirement. So we should have, at this point in time, 4.3 trillion more saved than we do in America for retirement. That's a pretty stark number there. 44% of families are contributing to the direct contribution plans, or defined contribution plans, excuse me. That's not even half of America. We need to do better. What's the average age of retirement? 66. That's the age most Americans expect to retire. And the average time in retirement is about 20 years. So if you think about 20 years, $7,800, the math's not really adding up in my mind. But that's okay, we're here to help today. And it's exactly why we're having this conversation today. You know, excuses are common. All this anxiety from the numbers that I just shared with you creates reasons for us to come up with reasons to block our ability to save for retirement. And the three most common that we hear are right here. I don't have the time, I don't have enough money, or I'm in debt. They're excuses. Let's call a spade, right? Let's dig through them though, and let me explain to you why you could be viewing the picture in the wrong way. I don't have time. That's like saying I don't have time to go to the gym. You have to make time. You have to make it a priority, right? And now more than ever, there are so many different ways that you can start saving for retirement with less time. We've got them listed here: technology, robo-advisors, ETFs. These all make life a lot easier for you when you're thinking about retirement. It takes less time to invest because of the advent of these items. We went commission-free. The whole industry went commission-free at the end of last year. It's a lot cheaper to invest now as well. And then I have starred, of course, here in this bullet point. You definitely have more time than you think. You got to be honest with yourself on that one. I don't have enough money as the second one. You know, again, you don't need a lot of money. You don't have to be rich to start saving for retirement. Robo-advisors like the one we have here at Ally Invest make it very easy. You need as little as $100 to open a robo-advisor with us. And there's comparable competitors out there that have very low entry prices. You can start a 401k at your company. The company matches. That's free money. Don't leave it on the table. You do have to prioritize spending though, because retirement is important. You can start with a little bit of money, but you need to make sure that you're actually starting with money. You have to start somewhere, right? And then the I'm in debt excuse. Look, I get it. There's a lot of student debt out there right now, and it can weigh on you. It can weigh on your mental state and make you feel like you don't have the ability to save for retirement or a trip or anything else, really. But the fact of the matter is, it's all about, again, prioritizing the debt that you do have. Take a look at the bigger picture. How much of that debt is credit card, high yielding debt versus, you know, your student loan, which probably has a low interest rate related to it, or a mortgage or other types of debt. You can still invest while you have debt. Again, starting with that little bit of money, you can start and still have debt while you invest. Also, you should always be making those contributions to your 401k when there's that company match. You're leaving money on the table otherwise. And again, remember, you can start small. It says it here at the bottom of the slide. Investing for retirement, it's not rocket science. It just takes planning. And I think what you can gather from this slide that I have here, the three takeaways are: you need to prioritize planning for retirement, you need to take the time, and you need to be disciplined about it. And that's not always easy. But let's keep moving on. And here we see, don't forget to ask questions, by the way. I'm going to take your questions at the end of the presentation. On the right-hand side, there's a place for you to type in your questions for me. And in fact, you'll be able to ask questions throughout the day to all of our speakers. So please be sure to take part there. We'll move on to the next slide here. Again, starting now is the most important thing. The sooner you start, the better off you're going to be. And that's exactly what this chart shows. I have to say, though, this is just a hypothetical example, and you know, it's by no ways a guarantee. We assume in this example that you invest $2,000 a year, and you do it for your entire life, and on average, let's just assume you're going to make 8% a year in the marketplace. Well, guess what? If you start saving at the age of 22, look at that. You can have almost $562,000 by the time you turn 62. But more importantly, look at the dramatic drop off in the bar to the right of that 562,000. If you wait just 10 more years to start investing that $2,000 per year, you're going to have less than half of what you would have had if you started 10 years prior. So you have $246,000 at age 62 if you start investing $2,000 a year at age 32. So the reality is real. A lot of that has to do with compound interest, making money on the profits you made in the year prior. So it just gets worse the longer you wait. So it's time to start, guys. Let's get off our butts and get going here. All right. So fine, we get it, Lindsay. We need to start. How much do I need to retire? Look, no doubt this is going to be your biggest financial goal that you've set in your entire life. But the good news is it's achievable. There's a lot of different rules of thumb out there, or conventional wisdom about how much you should save. You know, a lot of people throw that $1 million number around, and that sounds like a lot of money, and it is a lot of money, but it all depends on, you have to think about what kind of lifestyle you want to live when you retire, what age you want to retire, what your health situation is going to be, where exactly you're going to live. So there's a lot of things that you have to take into consideration. But conventional wisdom says save 10 to 15% a year throughout your entire working career and you should be set. If you're closer to retirement, there's another rule of thumb that says if you have anywhere from 9 to 11 times your annual salary, you should be set for retirement. But don't forget, you have 20 years to be in retirement. Remember, that was a stat I told you on the first slide. This chart here, though, shows where we stand in the U.S., what the median retirement account balance is by age. The dark gray bar there at the bottom showing 60,000. This number is much higher than that 7,800 that I talked about in the first slide, because this only accounts for people that actually have 401ks or IRAs. It doesn't include the people that have nothing. So 60,000 is the median. Of course, you have, the older you are, the more you have, the younger you are, the less you have. At the 35 to 44-year-old bracket is showing 37,000 median account balance, whereas the 55 to 64-year-olds have 104,000. So those that are saving are actually making progress. But still, we need to probably do a little bit better if we want to retire comfortably, right? So let's get started saving for retirement first and foremost. That's the first step, right? Well, here's a couple just quick tips. First and foremost, you need to prepare to invest. You need to plan to have your financial house in order first of all. An emergency fund is the first thing you got to do. You got to think about, there's different rules out there. 3 to 6 months is usually about a good idea of what you should have in cash or liquid assets to access should you lose your job. Think about it. If you lose your job, it's probably going to take at least 3 months to find a new job, right? So you want to have the money available to pay your rent, pay your mortgage, and take care of all necessary expenses if that situation were to happen. Next, again, on the debt situation, you just really have to commit to a plan. And it's really important to focus on having a repayment schedule for that high interest debt and to worry less about the low interest debt that might come in the form of student loans. And then once you do that, you have your financial house in order, we can start investing. First and foremost, first bullet here is your company 401k. Excuse me. Just get the match. Again, it's free money, right? The best part about a company 401k is once you sign up for it, it's money that's coming out of your account. It's coming out pre-tax, and I'm going to get into that more later. But it's money that you don't see and you kind of end up forgetting about, but it's growing over time. So that's the very first step and the easiest way to get started. Now, if your company doesn't have a 401k plan or you're an entrepreneur and you work for yourself, there's other things you can start doing. You need to first think about your near-term needs versus your long-term needs from a financial goals perspective. Because if you're saving up for a house that you want to buy in a year or two, or another financial goal, you're going to need that money in liquid assets. So that might be a certificate of deposit, a CD account, or a money market account that you might want to consider. But anything that you don't need for 3, 5 years plus should really be in the market, because you're not going to touch that money for a very long period of time. And we know history shows us, as I said at the beginning of the show, over the longer term, the S&P 500 returns about 10% on average. In our illustration earlier, we got conservative and took that down to 8% when I showed you the numbers of what you make if you start saving at 22 versus 32. But that's something to think about. And then also asset allocation. You can't just put all of your money in the stock market. You need to diversify. I'm sure you've heard that word a lot. And the key there is, again, different rules of thumb. I really like the 110 minus your age as a guidepost for how you should invest. Meaning if you're 40 years old, 40% of your money should go into fixed income. The other 70% should be in the equity markets. And the final bullet point is an IRA. If you don't have that 401k like I mentioned before, or you do, you can also invest in an IRA as a supplemental way to save for retirement because there are tax benefits. Again, I'm going to dig into that in more detail just shortly here. So what do I do, Lindsay, if I'm falling behind, right? Because we just saw the numbers, and here we have the stat on the left-hand side of the screen. Greater than 50% of Americans think they're not saving enough. That's because they aren't saving enough, right? We just went through the numbers. 50% of Americans don't have anything saved, which is okay because we can catch up if you're a little bit behind. This is not a problem. So here's some do's or don'ts for you if you are in that position and you want to get back on track. First of all, just like in retirement in general, you got to make a plan. Let's make a plan to catch up. And then the following bullet points under this are some ideas of how you can catch up. You know, you can increase your contributions to your 401k. If you're not getting the full match from your company, well, at least up it to that. In addition, you might want to start saving more than you have in the past. So increase your contribution. Also, you can make catch-up contributions too. Again, you can open an IRA in addition to your 401k to get that tax advantage and think about retirement in that way. You can make catch-up contributions. I already mentioned that. Right size your lifestyle. So if you're an older couple living in a big house and your kids are out, you might want to think about moving to a condo or an apartment. You can start thinking about ways like that to save money. Or maybe if you eat dinner out, 4 nights a week, maybe bring it down to 2 nights. I'm not saying you have to completely upend your lifestyle, but you might want to make small changes that can add up over time like that. And then again, you'll always have the option of working longer, getting that side hustle. Maybe you start an Etsy site. Maybe you become an Uber or Lyft driver to get a little cash on the side. Or you can ease into retirement. Instead of going into full-blown retirement at age 62, what you might want to do is go part-time for 5 or 6 years. After you go part-time, maybe you start working a couple days a week on a consulting basis for your company if they allow that. Those are just things to think about, and you can be creative and you can make it fun. It doesn't have to be that, stressful and intimidating. But what I would say is what you should not do is compare yourself to others. You're going to lose if you do that. That's never a good thing to do in life or in retirement. And definitely don't give up. You can do this. You can make this happen. You still have time. And definitely don't expect retirement to just work itself out. You have to take actions and you have to make a plan. And you will be held accountable for what your lifestyle is like in retirement. But again, you could do it. We're helping you out here today, all day. Next up, I want to dig more into this IRA versus 401k issue, because I think it's something that a lot of people get a little bit confused about. They both have tax advantages, and that's one of the key reasons that we always talk about these two types of accounts when you're thinking about retirement. I'm going to actually start with the 401k at the bottom of the page to talk us through that and how that compares to the IRA. Well, the 401k, we talked about it already a lot. It's a plan that's offered by your employer. So you make your individual contributions, but then your employer matches those contributions, usually up to 1% of your salary. It can be anywhere from, 1% to 10% maybe on the high end. Usually companies land somewhere in the middle to lower end of that range. And it's a really good way to, again, get the free money. But the problem is that investing options are limited. So what you'll usually do is when you sign up for this plan, you'll get a list of funds, ETFs, mutual funds that you can invest in within this 401k program from the provider. And it might list anywhere from 10 to 30 different options. So you don't have a lot of options. They usually do try to give you some sort of diversity within those options, though, so that's the good thing. That's probably just one of the most difficult things to think about when you are thinking about a 401k. Now, your contributions to the 401k, this is the most important thing, they come out pre-tax. So out of your paycheck, your employer takes whatever percentage you decide to contribute to your 401k out, and then the tax man can tax you based on what's left over after that. So you're lowering your tax bill up front. But at the end, you do have to pay taxes on your contributions that weren't taxed going into the account. So presumably, when you're at retirement age, you are in a lower income bracket, so your tax rate is going to be much lower. So you're paying lower taxes on that money that you put in pre-tax. Hope that makes sense. I have in parentheses there that you're required to take distributions at 72. That is just an IRS rule. The maximum contribution, here's the real great thing about 401ks too, in addition to that match, is that for 2020, you're able to invest $19,500 if you're under the age of 50. If you're over 50, you can contribute up to $26,000. That's that catch-up I alluded to. If you're over 50, you think you're behind, put the extra $6,500 into your 401k account and you catch up pretty quickly. So those are just the latest stats there. Now, how does this compare to the IRA on the top of the screen there? Well, again, it's individual contributions. Contributions are tax deductible, so you're going to make the contributions after you pay tax through your employer, but that'll come back to you when you pay your taxes at the end of the year. So you still get that tax-free contribution status. You have a much bigger selection of investments to choose from because you're usually investing in an IRA through a different broker-dealer that has the opportunity and access to those types of selections. Again, distributions, taxes, income, same as 401k, but the maximum contribution to your IRA is only $6,000 in 2020 if you're under the age of 50. If you're over the age of 50, you can do another $1,000, $7,000, which is really great. But do you see why, given the total numbers, the total amount that you can contribute, that it oftentimes makes sense to have both types of accounts? You get your match from your 401k, your employer. You can put in up to $19,500, but your IRA, you can only put $6,000 in. So it's good to have both types of accounts. It's just, a tax benefit for when you're thinking about retirement. Again, don't forget to ask for questions here at the end. I'll be taking them in about 10 minutes or so. But on the next slide here, I wanted to keep talking about 401ks because this is the type of retirement account that most Americans do have. It's the most popular type of investment with retirees. A lot of people have multiple 401ks out there, and that is simply because given over the course of a lifetime, any given person in America will hold 12 different jobs. 12, would you believe that? That wasn't necessarily the case 20, 30, 40 years ago. 12 jobs is a lot. So here's just some stats. If you have a 401k at a former employer, you're definitely not alone. There's 25 million people who have left their 401ks at old jobs. That's about 37% of workers who have 401ks. So most people have 2 or more accounts at old jobs. That's a lot of accounts to manage, right? So I wanted to bring up what options you have in managing those accounts that are at other firms. Well, you can leave it there. You can let it ride, right? In the first option here on the right, or on the left, excuse me. You could just leave your money there. You can continue to, at your new job, open a new 401k or IRA account with your new employer. But then you're going to have all these accounts, multiple accounts out there that you're going to have to track. It can be a logistical nightmare. Old accounts can incur unnecessary administrative fees, and it's just kind of just hard to track. So there are 2 other options you can think about. You could cash it out. I'd rather you leave it at your old employer than cash it out because first and foremost, there's penalties. If you decide to cash it out, take the cash early and you're under the age of 55, you're going to pay a 10% withdrawal fee. Plus, you're going to pay income tax on that because remember, you put the money in there tax-free. So you're going to have to pay tax on that. And then you're going to miss out on compounding interest that you earn on the returns. So it just really isn't the smartest thing to do, in my opinion. But you do have another option. If you don't want to leave all your 401ks at your different employers and you don't want to cash out, you can roll it over. So you can either roll it over into an IRA account or you can roll it over to a 401k with your new employer. You deposit your funds into the new account through what's called a rollover. This consolidates your funds into one account. Again, you don't have all those old 401ks lying around. You avoid the early tax withdrawal, which you would have in a cash if you were to cash it out. You avoid penalties. So this is, a very attractive way to think about former 401ks. So we kind of get the point that rollovers make sense at this point right now, right? So do I roll it over into my new job's 401k or do I roll it over into my own new IRA? Well, let's look at it. We show the 2 scenarios here. To roll it into your new job's 401k, there's some pros and cons. First, the pro is you are getting that consolidation benefit where you don't have multiple accounts to track. 401ks, as you may know, they do allow penalty fee withdrawals at the age of 55. which is earlier than most accounts. And you might be able to borrow against your 401k if you need to look for a house or something like that. Again, consult with your financial advisor about that. But the cons are you might have to wait a little while before you can actually contribute to your company's 401k, and you have to confirm that they can accept rollovers. So those are a couple things to consider when thinking about that option. Now, the other option here is to roll it into a brand new IRA with a broker-dealer or a financial advisor. The pros here, again, like we went through on the first page, is you have an increased amount of investment options. You've got more control over your accounts. There's lower fees. And again, you can roll all of your different 401ks into one IRA. So then you also get that consolidation benefit. You get the consolidation benefits in both scenarios here. The con is you're still going to have a separate account. You have the IRA and then you have your employer 401k, but that's 2 accounts instead of 5 maybe. So this is just a page to kind of lay out what your options are as far as choosing a 401k, new 401k rollover, or going into an IRA. But if you choose to roll into an IRA, Ally Invest, we're here to help you. What we offer at Ally Invest is an Invest IRA account. So that means you can roll over your former employer's 401k into Ally Invest, an IRA account that we have here. It's very simple to do. All you have to do is go online, open an account, and then you select where you want your funds to be withdrawn from and go to. It's very simple. And if you don't have an account, it's very simple if you have an account in one of the major brokers out there, like a TD Ameritrade, Schwab, Fidelity, any one of those. It's very simple to roll over. Now, if you don't have your account at a major broker, what you can do is call them up, tell them you want to roll over your account. They'll send you a check in your name, and then you can call our service people 24/7 hours a day, and they're going to hold your hand through the entire process to help you roll that account over. Look, the benefits are, again, of having an IRA at Ally Invest is we have access to thousands of stocks, ETFs, mutual funds, fixed income funds, everything you could dream of. In some cases, depending on your approved level of investing, you may have the option to make option trades. There's no annual fee. There's no maintenance fee. And we also offer the traditional Roth variations of IRAs, which I didn't get into in this presentation. You can spend a lot of time talking about that. But we have this option. So while we're a full service broker, dealer, and we offer managed portfolios, my last slide here kind of talks about some of the different products that we offer at Ally Invest. We're here to be your financial ally in your investments and in your retirement. And so we have many different ways that we can help you think through your retirement plans, and also thinking about your IRAs and 401ks. We're here to help you. So with that, my presentation is coming to a conclusion, but like I said, I want to take questions from the audience. So let's see what we've got. All right, and you can still input your questions if you haven't done it yet on the right-hand side. We're going to continue to monitor that all day long. Eric Larson says, what are the rules for early 401k withdrawals? So it's important to distinguish between a 401k withdrawal and an IRA withdrawal. In 401ks, you can withdraw as early as age 55, the year you turn 55, but you have to already be retired or laid off or fired at that point. And then the IRS will allow you to withdraw from your account. If you're not in that situation, you're going to have to wait till age 59 and a half to begin withdrawing from your 401k. Again, you don't have to start withdrawing at 59 and a half, but you do have to start withdrawing at age 72. And so very similar rules for the IRA. You don't have the 55 option in IRAs, but again, you can start withdrawing at age 59 and a half, and you must start withdrawing by age 72. What else do we have? We'll wait for more questions to potentially come in. Retirement is such an important topic. It can be very intimidating at times. but it is so worth your time and while and planning for your future. And we're here to make it a lot easier for you. All right, we've got another one. Boozy Gamer. I am self-employed. How can I use a 401k? Well, there are different types of 401ks available for small companies, but if you're just your own employee and you don't have other employees, the best route for you to go would be to explore IRAs and really start there. It's $6,000 a year that you can put away, and it's a great starting point. But if you are a small business, there are other options out there for you to consider and that you can research. Lady Katie, what is one of the most important actions you would recommend for those of us getting closer to retirement? Well, I think one of the most important things, this is actually a really good question. If you're getting closer to retirement, you can't just wait until you're in retirement to just start taking money out of your account. That's really not the best plan of action. What you need to do is have a plan in place. If you're about 5 years away, you should start making that plan. Start building your cash reserves that you're going to need immediately upon retirement. And then, think about what type of money do you need? How much money do you need on a monthly basis when you are in retirement? And the other thing to do is consider consulting a financial advisor, because you want to withdraw your money from your 401k in the most efficient way possible. And an expert can really help you do that instead of you just, picking here and there, I'm going to pull out of this account or that fund. You can do it in a more strategic way that'll be a more efficient use of your funds. Anything else? We've got a long day of really great experts ahead, and the next presentation that we're going to hear from is Andy Hill, who's going to be interviewed by our leader, Lyd Damase, here live. They're going to talk about the FIRE movement, how he got involved in it, what it all means, and how it can make you maybe think about retirement a little bit different. That's one of our biggest goals here with initiating this conference, was really to get the wheels turning in your head about the way you think about retirement. Because there's not a set path in stone for everybody. You have to do what's best for you to fulfill your future needs.